If someone showed you this chart right now, could you tell the difference between buyers getting trapped and sellers getting absorbed? Most traders can't. They hear words like delta, absorption, liquidity sweeps, and imbalances thrown around every day, but they never actually learn what they mean. So in this video, I'm going to break down the most important order flow concepts in plain English using real Bookmap examples so you can start reading market intent instead of just guessing where price will go next. But before we look at Bookmap, we need to understand how the market actually moves. I want to make sure we understand how the market moves. It's a theory called the auction market theory. It states that the market is a continuous two-sided auction where buyers and sellers are constantly negotiating price. The market's job isn't to go up or down, but to find prices where the most business can be conducted between willing buyers and sellers. Think of a live auction. The auctioneer keeps raising or lowering prices until buyers and sellers agree on value. Financial markets work the exact same way. When buyers become more aggressive than sellers, price moves higher in search of new sellers. When sellers become more aggressive than buyers, price moves lower in search of new buyers. When enough participants agree on a price, the market temporarily accepts that value, and when they don't, the auction continues and price moves elsewhere. This process of discovering value is exactly what order flow allows us to observe in real time. So now let's open up Bookmap and actually see that process happening on a live chart. Here's some basic Bookmap knowledge so you can understand the concepts that I show later on. The lines above the price is the resting sell orders. The lines below the price is the resting buy orders. The green bubbles are the aggressive market buy orders, and the red bubbles are the aggressive market sell orders. And aggressive orders hitting the bid or ask are needed to move the market, or else it'd be a standoff of orders not being filled because nobody wants to pay the opposite side's price. The space between the best offer and the bid is the spread, which a market order has to effectively jump over to make a trade. Let's look around Bookmap first. You might see this massive graph at the bottom. This is the cumulative volume delta, or CVD. Now, the CVD is the total executed buys minus the total executed sells of a chart. The CVD going up means there's more buying pressure, and it going down means there's more selling pressure. Another important methodology in CVD is a CVD divergence. It occurs when price is going in one direction, but the CVD is going in an opposite direction. This essentially means that even if price is going up, the sellers are more aggressive. This could signal exhaustion, as it may not be aggressive buying pressure, but instead the lack of sellers. This leads to new price levels to be targeted after something like absorption, which is exactly what happens here. And also, if you don't understand what exhaustion or absorption is, don't worry, we're going to get to that later. A rising CVD during a pullback could mean that the buyers are absorbing the dip and preparing for continuation. Okay, let's look at what layering and absorption is. The basic English definition of layering is the act of stacking or arranging things one on top of the other, which happens in Bookmap with orders. Layering is the large amount of limit orders at one or more directly correlated price levels, and it can be anticipated that a decision point is coming up when price hits that level, whether to continue, reverse, or simply slow down to a halt. The slowing down that happens when that layer is hit is called absorption. It's when a large amount of orders, for example, the layers, are executed, but price doesn't move because large passive orders are being filled on the other side. Limit orders take up and absorb all the aggressive buying and selling activity, and it signals a potential turning point, not just a slowdown, as the large players are absorbing that flow and positioning themselves for a move in the opposite direction. Now, in this image, layering can be seen with the three yellow lines at the top as well as the orange ones in the middle. Notice how most of them are being absorbed, and while they're being absorbed, price begins to slow down. This is a signal of layering turning into absorption, and you can tell if it's absorption by just looking at the large limit order or if there's repeated execution at a level without price movement. Something that correlates pretty closely to absorption is accumulation. It's the adding up of orders in a certain direction, usually not in one full massive order, but multiple small ones. This is different than absorption, as in absorption, price cannot get through a price level, while in accumulation, it does get through it, all while still accumulating those buy or sell orders. This can often happen after spoofing, which is simply just fake orders that get pulled before execution. But there could also be other things that happen before accumulation. It often serves as a sign of interest in buying or selling, or just buy or sell pressure accumulating. Earlier, I was talking about trends and exhaustion. Well, exhaustion and rejection provide pretty good context when it comes to the end of a trend. Exhaustion in a trend occurs when there is a lack of trading taking place, aka low volume. Another confluence is failed pushes despite strong and large volume, especially near previous key price zones and levels. Notice the high buying pressure on some of the pullbacks still lead to no reversals. Rejection is when price breaks out slightly into a new price level and then reverses, showing failed continuation. Bookmap helps with locating rejection through looking for strong volume met with absorption and suddenly liquidity reappearing. The graph shows a lack of aggressive sell orders hitting the bid, leading to exhaustion and then price moving up through an aggressive buy order. Now, the opposite of exhaustion is a sweeping of an order book. Now, the sweeping of an order book is when it trades through one or more price levels, and it's often how price trades into new ranges. Usually has a combo of imbalances and aggressive orders. The example that I'm showing shows the sweeping of 3 price levels with a 50 unit market order. Market orders, unless cancelled, will keep going down until the order is fully filled. And that's exactly what happened here. It creates a vacuum between the best bid order for a short amount of time. One of the simplest things you'll learn in order flow is an order imbalance. An order imbalance is when the current order book goes from equal to, for example, having high orders on sell side. This causes a supply imbalance, and liquidity is often pulled on the buy side, resulting in a wider spread, or the lowering of the best bid, and a value shift in the intent of trade. Now, the intent of trade is something pretty important. It can move price even if orders aren't executed. And what I mean by that is the intent of the market and where it wants to go can be influenced by limit orders, which is why Bookmap is so important, as in a raw candlestick chart, you can't see the limit orders. Now, I'm sure you've all heard of fair value gaps and common trading terms like that. Well, to put it simply, Bookmap allows you to see the actual prices where volume is low through low and high volume nodes, which are simply just fair value gaps. A low volume node is often when price goes past the level quickly and many orders aren't executed at that level. It occurs during a sweep or a change in trend, and it's where the lowest amount of executions occur in a price range. A high volume node is where a large amount of volume is traded, not to be confused with a PLC, which is where the most volume in a range is traded, and there can be multiple high volume nodes, but only one PLC. Now, the PLC, or a point of control, is the price level with the highest activity in a given period. Now, if you measure it in traded volume, the PLC is the price level where the largest volume size was traded in that period. This is maybe half of everything in my notes. If you'd like a more complex video explaining everything else, such as book flips, stair stepping, spotting algos, real versus fake liquidity, how reversals work, illegal order flipping, and a whole lot more, leave a comment. I'll make another video if this one gets a few comments and maybe 10 likes. Once again, if you've made it to here and you found this video useful, make sure to leave a like and subscribe as it helps me out a lot. I'll see you in the next one.